Welcome back. In this video, we are discussing the new Andrew Left Citron short call. We've been doing this as long as I have. This actually rhymes with a short call made by Andrew Left on Palantir in 2020. We're going to discuss all that it means for PLTR today. So on August 18th, anchored to the rumored $500 billion OpenAI valuation, he's saying even giving Palantir a generous price to sales multiple makes the share price worth $40, and that's a 75% drop from today, the current price. So why it matters now is Palantir has some real operating momentum, first billion-dollar quarter, the U.S. commercial acceleration, and an extraordinary multiple. A lot of investor confidence is another way of saying that. And so this is the tension here. This is the asymmetric re-rating risk that you can say if you are a bear. So what Citron is arguing here in 2025 is that if OpenAI trades at the high teens of price to sales, parity would put Palantir at $40. Palantir's price to sales and PE sit far above top-tier software, and multiple compression could be what causes the stock to decline. We've had a lot of insider selling, but that's always been the case. I largely dismiss this because insiders were selling at $15, $20. Now the stock's 10 times that. So I dismiss that entirely, but we're going to be talking about the rest of the points. Citron's equivalence here is between a private LLM provider, OpenAI, and Palantir's defense-grade operating system. That's sort of the controversial leap, is can you really equate these two? Last time Citron shorted Palantir, and here's why it matters. So in November 27th, 2020, right after Palantir went public on September 30th, 2020, he said it was a full casino and it was a stock worth $20, right? Not much higher. And it did sell off intraday after that. That the short tweet cover within minutes sort of got him in trouble there. And that Citron does move the tape, but historically, he's not supposed to be doing that, sort of manipulating the markets a little bit. So here's where Palantir is today. We had that $1 billion revenue quarter, the first time they've done that, up 48% year over year. Commercial revenue, we're not going to go through all these numbers because we've discussed them previously. Guidance is great. Q3 guide is great in addition to the fiscal year 2025. Growth at 50% year-over-year run rate AIP boot camps, materially compressing time to value and feeding that velocity. And there's discussion around this U.S. Army Enterprise Agreement, which is a 10-year ceiling up to $10 billion, which is an enormous deal, right? And it consolidates 75 contracts and introduces volume discounts. So a ceiling is not really equal to revenue. We can expect a lot of lumpy drawdowns and some competitive nature to it and a lot of noise around it. But it entrenches Palantir as the lead contractor and continues their credibility. So I think it's great overall. But for valuation, we've talked about this for a long time. It trades as an outlier, but for good reason. We know the rule of 40, Palantir demonstrates above 90 on that metric. But the thesis here is that if OpenAI's private market cap deflates or AI premiums compress, a highest multiple proxy like Palantir would get hit first. But the counterpoint is that Palantir is basically the only profitable AI software company. You can say NVIDIA is wildly profitable, but of course that's on the chip side. Who else is profitable? OpenAI isn't, XAI isn't, Google, you wouldn't even see those numbers, right? Anthropic isn't. Of course, they're profitable on the inference, but they're not profitable businesses on a, GAAP basis, which Palantir is, and they're basically one of the only ones doing it. Mission critical deployments justify the premium, and, what they're doing in defense, no one else can really claim. So if you want to run the math yourself, how you get a stock price is revenue times price to sales divided by shares outstanding. But we've been through this before. So here's what the scenario looks like. It implies a high price to sales persisting over time or faster than consensus revenue. So this is sort of how do you back into the actual bear case here. So the first row we have is 2026 revenue of a little under $6 billion at a price to sales of 20, which is sort of what Andrew Left is saying. You get a market cap of $100 billion, a share price around what he says at $47. And then you could look at different scenarios, like what if it's 25 times, 35 times? What if you look at 2027, 25, 35, 50 times? And that's sort of where you get to today, is the market sort of pricing. Either we're going to have much higher revenue than $7 billion, or we're going to see a decline of about 2 times in the price of sales as that compresses over time, but not more than that. And that's sort of how you back into the price today and in the implied market cap. So you can play with that. But the short interest is very low. The borrowing is low. It's limited for any sort of squeeze setup. And near-dated call activity is showing nothing spectacular. Palantir remains very beta sensitive to AI headlines, and I think it will continue to do so. So where is Citron right versus oversimplifying and flat out wrong? So right, valuation is a real risk. I mean, this is true for any stock. And, we got to be careful about what's instant revenue versus there's a lot of work. But if anyone's good at dealing with these contracts, it's Palantir. Regarding oversimplification, OpenAI parity, like to even compare these two businesses, is kind of lunacy because the business models are totally different. The stages are totally different. CapEx intensity, Palantir doesn't have that, but OpenAI, of course, does. Gross margin, distribution, really everything. Palantir's already GAAP profitable at scale. As for hype narrative and overlooking, a lot of the TCV and RDV and commercial velocity, I think that's pretty evident. So if we were to look at this narrative going forward in the next couple months, we would want to back it up, see U.S. commercial keeps chugging along with large deals, quick deals, ideally less insider selling. But again, I don't even necessarily care about that. And we'll have to see what happens with the OpenAI IPO potentially, or, if they're doing a secondary sale now, it probably means the IPO wouldn't be happening this year, but maybe into next year. I think largely it's, even a good thing for Palantir when investors are looking at OpenAI and they're like, well, the valuation's a little rich. Where else can we invest? OpenAI is not even profitable. Let's find a profitable company. Only goes to benefit Palantir even more. So the final take is, if you're long for the decade, respect the multiple and sort of pre-plan any sort of compressions that can happen over time that don't assume any execution breaks, then I think you're set. But if you're sort of fading the call, you got to recognize that Palantir is the wrong kind of execution machine to actually be casually short into any sort of prints, especially earnings, which we've just gone through. So we'll have to see what happens the rest of the quarter. And the most sort of probable medium-term path is a minor compression. Of course, not because of what Andrew Left has said, but because the valuation has sort of pumped considerably, and Palantir's going to back into it with very strong fundamentals, unless the commercial is able to keep defying gravity. Now, I'm not saying Palantir's destined to crash anywhere near $40, but, we're talking about a bear case here. I think it's, fair to expect a drawdown sometime in the future. Stock's not only going to go up, right? So in a bear case video like this, I think it's entirely fair to say we can, expect a drawdown in the future, be prepared for it, ready to deal with it. And that's sort of my take. I don't think this is a thesis breaker at all. I'd love to hear your thoughts, and I feel like we're just sort of doing this again. I think Andrew Left's going to get his face ripped off again, but that's just my thoughts. Until next time.